Welcome, everybody, to the Grid series where we talk about real estate investing, how to get the money for your deals. If you need money, I'm the money lady. I'm the person you come to. I am Cheree, the money lady, and I work with the Gridiverse with regards to helping you get the funding that you're looking for, whether it is for your own home or for a vacation home, Airbnb, long-term rentals, all sorts of reasons. And of course, today's topic is one of my favorite topics, which is generational wealth, building and growing your wealth generationally, buying a home with your adult children, some of the things that you need to know, be aware of, and also think about strategically as you're doing that. So, I am here with the very fabulous Buky Delle, who is with the Casa Group. And Buky, why don't you tell everybody who you are?
All right. So, like Cherie mentioned, I'm Buky Delle. I am a realtor and also consider myself a real estate planner with the Casa Group. And part of what I do is helping people plan for the future. So, helping you build, protect, and transfer your wealth that you've built through real estate. So, all of that, being able to protect your wealth and transfer your wealth begins with pre planning and even building generational wealth, like Cherise said, begins with planning. So that's what I do in a nutshell.
Fantastic. How long have you been in real estate and how did you even get into it?
So the story about how I got into it is really funny to me anyway. But I've been in real estate for 21 years and probably about 22 years ago I was up late, and this is probably showing my age a little bit. I was watching an infomercial and Carlton Sheets came on TV. He had infomercials a lot back then, and his whole thing was buying real estate with other people's money. And I heard it and I thought, that sounds great. I'd like to do that. And the next day I spoke with my boyfriend at the time, and I told him I'd like to buy real estate with other people's money. And he introduced me to a friend of his who was a realtor. And she said, "Hey, I think you should get your real estate license." And that's what I did. And that's how I got into real estate. So it wasn't
Fabulous.
it wasn't, a family, no one in my family was in real estate. It came out of the blue, came out of the blue.
I think sometimes those are the best stories as well, where like, within one instant, within one like encounter, you're
Yeah.
able to change the trajectory of your life. So you're a realtor. If you, let's say, have a parent and they have an adult child, what are some of the things they should think about, like, before coming to you, as they're coming to you? Like, guide us through, because I know you have a couple of bullet points. Guide us through the process that you would put them through, with regards to thinking about this.
Yeah, so with adult children, and just to clarify, we're talking about adult children that have just graduated from college. So that's where my focus is on this conversation. And one of the best ways that you can gift your children a financial head start is helping them to buy property, to buy real estate. And as a parent, you can help them either by co-signing or assisting with down payment funds. The benefit for your child is, we know that rents are high. We know that if they buy real estate, they are starting to build equity instead of just building somebody's equity. And even with little employment history, you helping them allows them to be able to buy a home. Because traditionally, you need a certain number of years in your job in order to qualify for a home. So with these graduates, they don't have that work experience, the employment experience. So by helping them, you can circumvent that and help them potentially qualify for a loan. So, and then really just building wealth for the future. Yeah.
I'm sorry, I was on mute. Yeah, and I will say, interject here, as a lender, we don't even need your child to have graduated from college. You may decide, hey, my child is going to college. Maybe they're coming to the DC area for college, and I want to buy a property for them that they're going to house hack. Well, that is possible as well
Mhm.
where um, you know, they could, and I'll talk about this a little bit later on, but they could be on the title or they could be on the mortgage or they could be on both. We do have some parents that decide that they will uh, take out the mortgage themselves, but put their kids on the title. So that is totally a possibility.
And, Sheree, I'm glad you said that about going to college. You and I were chatting before we started the webinar. I went to VCU in Richmond, and my brother went to VCU. He met his wife at VCU. So all three of us graduated from there 23 and plus years ago. And my nieces are now at VCU. One of them just graduated a couple of weeks ago, and the other is at VCU and will graduate from there. And what you said is so, so important because if we had known then what we know now, my brother and I, his wife, we all could have bought properties. At the time that I went to VCU as a freshman, I lived on campus, but after that, I rented in an apartment. So did he, so did his wife, and we rented for our entire college career. And if we had bought something, whether together, my brother and I, or separately, 23 years later, we'd be in a much different place.
Absolutely. And I have a lot of people who come to me, and that's the scenario where their kids are going off to college. And, sometimes the parent will say to me, well, they're going to college, but I'm not so sure, like I kind of want to wait, right? But you know your kids, that kid that's like, no, they're going to college and they're going to finish, right?
Yeah.
So you feel more comfortable putting the investment there. And then the interesting thing about this is from a lending point of view, if your kid goes to that college, they buy that property, and they are on the mortgage and the title, we consider them a primary homeowner, which, sorry, which means they can get in for 5% or even 3% down payment.
Mhm.
So you are able to put up a lot less money in order to get that property. And then once that child graduates from that college, then all of a sudden you've got a rental property that can be rented out to other people as well. Either that or they could sell it, either one. But if you are like us and you're trying to accumulate properties, this is a great lower cost way for you to do that.
Mhm.
Yeah.
Yeah, and, you mentioned house hacking, it's really what we did as college students. We had roommates, and but we house hacked in somebody else's property. We could have been doing that and building our own equity, but we just didn't know then what we know now. One of the things that I look at too is buying in the right areas, maybe near the schools. So that would have been a great thing for us because there's always turnover in those properties, near employment centers, near transit, metro, bus stops, etc., and buying in places that appreciate areas that appreciate. So, types of properties that tend to appreciate are townhouses, single family homes in certain areas. If you're lucky enough to live in a place that has 2 to 4 unit, or that have 2 to 4 unit homes, I mean, those would make great properties for this.
The other thing is our boss, Rob Chavez, shout out to Rob. He went to Florida couple of months ago and he was staying in they had a garage and they converted it to a two-bedroom apartment. And what you're able to do with these houses sometimes is you're able to convert, because you're going to be house hacking, you're able to convert different sections of that house in order to have more bedrooms. I even saw a YouTube video once where it was a college town, college house, and they were going to be renting the house to college students, and they converted right underneath the basement stairs. They converted that to another bedroom. It was so
Wow.
well done. Exactly. So when we start talking about ways where you're able to take this property and maximize the cash flow that comes from it. And we're not talking about having Animal House, I think is what it was, where people are having, parties every weekend, right? There are ways for you to do smart rentals for this. However, there are ways for you to maximize the rental income that comes from that property. So, so let's say after college. Um, they're getting their first job, right? They're moving to wherever they're moving, new city. What are some of the things that you suggest that parents and their children think about as they're thinking about purchasing those properties?
So one thing to make note of is the property has to be the primary residence of the child that the parent is purchasing it for. So it would have to be where the child is living, where their job offer is, for example. Buying something that with the intention of maybe house hacking or for future investment purposes, just thinking ahead. So, but whether it's a I prefer 2 bedrooms or more, 2 bedroom, 2 bath or more, because then you can house hack, you can have a roommate, you have different scenarios that you can play with. If you are buying something that's a 1 bedroom, 1 bath, I think location in that sense would be key because you wouldn't be able to house hack that, but that could potentially become a future rental. So looking at the rental market as well, depending on what your exit strategy is going to be. Thinking about your exit strategy is key also. Are you co-owning child and parent, or is the parent co-signing? So these are things that we talk about as a team. And when I say team, I mean the realtor and the lender and consulting with your tax professionals, because there are pros and cons to co-owning versus co-signing with this type of situation. Also,
Oh, before you go,
mhm.
what is the difference between co-owning and co-signing?
So with co-signing, the parent is on the loan only, and they have the liability when it comes to the mortgage, but they don't have ownership. So the child has ownership in a co-signing situation and all the control, and the parents do not. When the parent is a co-owner, they are also on the deed, and then they have control also. So, depending on how you look at it and who's looking at it, that could be a pro or a con.
And I just also want to say your child can be on the deed and not on the loan as
Mhm,
well. So the question is also, does the child want to be an owner? Or all of you are making the decision, right? Parent and child. Uh, or are they going to be on the mortgage or not? And
mhm,
one thing that I will say, so you're kind of going through my bullet points, but I think it's a good time to interject this. From a lending point of view, um, first-time home buyer benefits. There are two major benefits for first-time home buyers. The first is that the child is able to get a 3% down payment option because they're a first-time home buyer. Um, the rules for being a first-time home buyer is you have not owned a primary home in the past 3 years, right?
mhm.
So it's the 3% down, and also there's usually lower interest.
Yes.
There's usually lower interest for the first time home buyer. So I do not suggest for my grid investors for your child to be on title if they're not on the mortgage,
Mhm.
because then you would have quote unquote wasted their ability to get 3% down. Because if your child is on title only and not on the mortgage, you can't get the benefit of the 3% down payment and the lower interest.
Mhm.
I will also say, because you may say, well, Cheree, my kid doesn't have a job, they don't have any money. They can still be on the mortgage even with no job, no income. We would just put a zero by their income. Now, you want to make sure that your kids do not have like a big car note, for example, if possible. Um, some of you are paying for your kids to go to college, college tuition. Great. If your kids are taking student loans, then are they on deferment? Those are some of the things that will come up in their credit report. So we'll still need to make sure that their debt to income ratio works with you, but these are some things from the lending point of view that I would suggest that you think about when you're thinking about your strategy of co-signing versus co-owning. The final thing I will say, and this is just because it's an opinion, this is my opinion, I would not suggest you be a co-signer on something that you do not own. That's my opinion. That's my opinion. You would want to
Yeah.
have equal ownership because your child would be the only one that would have the ability and the authority to sell that property or to refinance that property. Um,
Mhm.
so I definitely suggest that if you're going to be on the mortgage, you're also on the deed.
Yeah, I highly recommend that as well, not just in this type of scenario, but in some other scenarios. And when it comes to owning the property, there are different ways that you can take title, whether it's joint tenancy or tenants in common. And when it's joint, you have equal ownership. When it's tenants in common, then you have the ability, if you wanted to sell your share, you could do that. So I don't know what the lender requires, but those are just options on owning, on taking title.
Yeah, we have something very similar with regards to titles. So it depends on sometimes what state you're in as well, how those things flush out.
Yeah. Yeah.
Hmm.
And then, of course, I always recommend that people talk to their CPA or tax planner in any situation when you're buying property, just to see if there are any implications with taxes. So, especially if you're gifting money. So, definitely do that. I'm not a CPA and not a tax planner, and I'm pretty sure Cherie isn't either. So,
I did consider it though. I did
yeah.
consider getting my CPA at one point, but no. Mhm.
I have never considered it. Yeah.
So I will say, as for the CPA
Mm,
tax planning point of view, it's not only too important to talk to them with regards to like, should you be an owner, you know, buying the property, gift funds, things like that. It's also important for you to strategize with regards to if you're going to house hack or if your kid's going to house hack, the rental income that comes in and whether that's going to go on your taxes, on your kids' taxes, are you splitting that? And I will say this as well. The way that you do your taxes, this is very important. The way that you do your taxes could negatively impact, meaning you may be denied for future loans. If your kids are house hacking, if you're renting out space, right? And you do your taxes a certain way, and if you want to talk to me more about it offline, we can. If you do your taxes a certain way, and then all of a sudden you want to go and buy another primary home, you might get denied. if you do your taxes or your kids do their taxes a certain way, and all of a sudden they decide they want to get married and, go buy another house or whatever, they may get denied for future home loans based on how their taxes are done. So, not only talking with the CPA when you start filing for the rental income, but also talking to me or your lender and saying, "Hey, I want to buy another property in the next 2 years." So, two tax cycles. So, we're looking at what you put on your taxes in 2023 and 2024 for what you want to buy today.
Mhm.
So I heard someone sneeze. So Lynetta, you came off mute. You have a question? Okay. Lynetta, I think you just came off mute. So, all right, go ahead, Buki.
Yeah, you made a great point with that. And one of the questions that I've received as a realtor is, will this impact my ability to buy later? And as a parent, if you're buying this home for your child or co-signing for them, that loan will show up on your credit. So it will impact your debt to income ratio. So that's another conversation that you have with me, you have with the lender, with Cheree about your future plans. So we're not just buying and planning for today, we're also planning ahead for the future.
Yeah, that is so important for you to think 2 to 5 years ahead. Who's going to own the property now? Who's going to own the property at that time? What things do we need to shift and change, etc. Um, I don't know, Buki, how controversial can I be? I probably should ask Ria this, but
Go
I'll
all
say
in.
something. I'll say something controversial. If your child starts dating somebody you don't necessarily care for, and they move them in, depending on what state they live in, you know, um, educating yourself, educating your kids about landlord laws. And there are certain states, as we know, that once the boyfriend or the girlfriend moves in, it's incredibly difficult to get them to move, especially if they're paying rent, things like that. So these are some of the adult conversations that we need to have and we need to think about, and being honest with ourselves as
Mhm.
well, you know?
Yeah. Yeah.
Yeah.
And I think that's important to discuss to prevent future problems.
Mhm.
But that also reminded me another question that I typically get is, as a parent, do I have to live there?
No.
You don't. You
No,
don't.
you don't.
Mhm.
Yeah. So the way that it works technically from a lending point of view is you are a non-occupant co-borrower, and that's perfectly fine. Just
Mhm.
one person needs to be living in the property. So that brings up another great question from a lending point of view. Can my kid move from that property and do I still get to keep that same mortgage? The answer is after 12 months, the kid has to live in the property for 12 months. Month 13, they can move someplace else. You don't have to refinance. You don't have to do anything except keep paying the mortgage. That's it.
Mhm. Well,
So,
Sheree, what happens if that kid gets a job transfer 6 months in?
uh, so I will give you the unofficial
Mhm.
response. Keep paying the mortgage.
Mhm.
And as long as the mortgages continue to be paid, 99.9% of the time, nobody's going to come knocking on the door. So,
Yeah.
you can decide that you could sell it if you chose to, or, um, you could rent it out. I
Mhm.
would again suggest that you just keep paying the mortgage.
Yeah.
But the official rule is 12 months.
Yeah, and life happens.
Hmm.
Life happens. You can't control
Yeah.
that, whether it's a job loss or a job transfer or
Hmm.
something along those lines. But as long as
Hmm.
your true intention was to have your child live there, then
Hmm.
keep paying the mortgage
Yes.
before you said
So
sell.
That's a great point of, and this is not even in my notes.
Mhm,
I definitely suggest you have reserves. If your kid had to move, your child had
mhm,
to move, and you had to pay not only your mortgage, but their mortgage for 2, 3 months, could you do it?
mhm,
Do you have either the cash flow, meaning you have like nice paying jobs, etc., or you have the cash reserve somewhere where it's not going to totally impact your financial status while you're getting a new tenant in the property.
mhm.
Because if you don't, then this is probably not a good solution for you. Because, like Buki is saying, things can happen and do happen.
Mhm.
And, um, job loss, all sorts of things like that can and do happen. So, job loss, job transfers, etc. So, I do think that this is something where you need to kind of be smart and think, do we have the reserves if we need to um, get another renter in here without having to hurry up and you end up getting the wrong renter in?
Yeah, and that's one of the reasons why I love the idea of getting a property that you can house hack,
Mm-hmm.
because if there are other people living there and just one person has to move, then you're not in a bind.
Mm-hmm.
You have
Yeah.
that income that's still coming in from the other tenants. So that's one of the things that I like to look for is not just an area that has a strong rental demand, but
Mm-hmm.
also a property that allows for house hacking or a roommate type situation.
Mm-hmm. Yeah, absolutely.
Mhm.
So, uh, the house hack king within the Causaverse is a guy
Okay.
named Mike Weber. Shout out to Mike Weber as well. One of the things that he says that I did not know and I really like is the fact that if it is a primary home, let's say I'm super sensitive being a woman, right? My daughter, right? Uh, when it is your primary home, your daughter can make the decision that she only wants to rent to other women and other girls, or other girls that are undergraduates within her university, or graduate students within her university. Mike Weber has informed us that the federal fair housing laws do not apply when it is your own home. So that's another great thing as well, where you as a parent can know, like, hey, and you have the conversation with your daughter, and sometimes your sons need to be protected as well, right? Like, hey, these are the people who can rent within this house hacking situation, and everybody else is like no go, right?
Mhm,
And that can be important as well with regards to protecting you and protecting your children and your investment.
mhm.
Um, a couple of other things that I had on my list is multi-unit properties. So you had kind of started talking about it, but we didn't really dig deep into it. So multi-unit could be 2-unit, 3-unit, 4-unit properties. Above 4 units, you start getting into commercial.
Mhm.
Buki, what can you tell us from the realtor point of view about somebody buying something with their adult child that's a 2 to 4 unit?
So, what I love about multi-units, and unfortunately, I live in an area where we don't have that as a true option. But what I love about it is you can buy the multi-unit, you can use FHA financing for a multi-unit, and your child can live in one of the units while renting out the other unit. And the goal in that is to make enough from the other units to cover the full mortgage of the property where your child is basically living rent-free or for a very minimal amount out of pocket. Yeah, so that's what I love about them, and if you're
Yeah.
lucky enough to live in an area where that's an option, definitely take advantage of it.
Yes. So from the lending point of view, the great thing, again, if your child is living on the property, is the down payment is 5%.
Mhm.
It used to be 20% for a multi-unit, but it is 5%. It could even be 3.5% for the FHA loan. And
Mhm.
that's again for a 2-unit, 3-unit, or 4-unit. Um, if you're buying a duplex, a 2-unit, then uh, you your spouse, if your spouse is going to be on it, and the child, you need to be able to afford the entire mortgage on your own without considering the income coming in from the other unit.
Mm.
House hacking, take a step back. House hacking, if it is 1 unit, we cannot, in the mortgage application, count any of the expected rental income for any of the house hacking you're going to be doing. Okay? You have to be able to afford all of that on your own. By the time we get to 3 and 4 units, though, we can count the rental income you're expecting from the other units within your debt to income ratio. So what they do is, let's say that we expect $1,000 per unit for, you got a 4-unit building. We expect $1,000 in rent per unit. I'm just doing this for simple math. What we will do is we will add $750 to your income in order to qualify you for that mortgage. So again, that's for a 3 or 4 unit property. But it's a great way for you to get a multifamily and
Mhm.
to do it for 5% down. So I'm always looking at like how do you put as little cash into the property as possible. And then, when you or when your kid moves, then you and your family have another asset. You have
Mhm.
another asset that you can continue to rent.
Yeah.
Mm-hmm. Yeah.
Yeah.
Uh, now. Um, I have 2 more things that I have on my list, and then we'll open it up for questions. How do you get off the mortgage? Right? At some point you're like, "Hey, I want this off my credit. My kid can fly now, what should we do?" Right? Uh, you could sell the property, but we mostly don't want to do that. You can refinance the property, but your child needs to be able to, on their own, have enough income to be able to afford the property on their own. Or if it's turned into a rental, then what the lender is going to do is um, they are going to look at the property, look at the equity, make sure there's more than enough equity in there, and they're going to look at the rental income, and depending on the kind of loan that you're getting, you might be able to just turn it into a DSCR loan at that point. If there's not enough rental income to afford the mortgage, then it may need to be a conventional investment loan. But your kid would be able to have their income from their job plus the expected rental income as their income. And as long as the debt to income ratio works, then we can convert them into taking you off the mortgage,
Mhm.
and you could still be on title.
Yeah.
Aha. So you could be taken off the mortgage and still be on title because it could still be a family asset at that point. Um, we would want to make sure that your child has 2 years of work experience before you try to refinance, just because it reduces friction. Okay?
Mhm.
From the lending point of view. And yeah, those were the bullet points that I had with regards to that. So, Buki, any thoughts with regards to the parents kind of getting out of the responsibility of ownership or, borrowing or things like that?
Yeah, I think that's where it's very important that you have conversations up front,
Mhm.
because even when it comes to refinancing to get one party off, there has to be full cooperation there. Both parties have to be cooperating in order for that refinance to move forward. And so that's it. That's all I have. Talk, have the conversations before you get into real estate jointly with anyone.
Yes, yes. So, um, the final thing that I had on my list, because I had this conversation with a parent this morning, parents and child are buying the house together for the child to live in. And mom said, well, what happens if something happens to me and dad?
Mm,
And I said, this is me. I am not a financial advisor, so talk to your financial advisor. My mom and I lived together. I bought the house. My mom moved in with me.
mm,
I have a life insurance policy. I've actually have a couple of them, but one of them specifically is for her to pay off the house if anything happens to me.
mm,
So during your strategy, during your conversation, you may want to talk to a financial advisor as well. But um, now, my life insurance policy, there are policies out there that are mortgage life insurance policies that are like directly tied to the mortgage. I chose not to have that policy. I have like an independent policy. I got it for the amount of the mortgage when we bought the home. My mother's going to get a check. She could do anything with it. But I said to her, my first choice is for you to never have to worry about where you're going to live. And she said to me, well, Cheree, duh, like where. So she's going to pay off her mortgage. The only reason why I like that a little bit more, and this is again just for me, is because I do want whoever survives me to have a choice with what they do with the money because, things happen.
mhm,
But there are life insurance products that are specifically tied to the mortgage. So if you know that that kid, like you're like, no, I absolutely know that I want this money to go towards paying off the mortgage, you could do that. Or you
mm,
could talk with your estate planner and set
mhm,
up a trust
mm,
where it would say, like, this is what happens with this specific policy, this specific money, etc. But I know that sometimes parents do worry about that. Like, what if my kid doesn't have dad and I to support them anymore
mhm.
financially because of that event? And I just want to let people know that that's an option. So, thoughts about that, Buki? Anything else you've heard people talk about?
Yeah, I feel the same way. I love to see people estate plan ahead of time. So when you put it into an estate, you talk to your estate attorney. Um, just like Cherie said, you can earmark what the funds are for. So it gives you the flexibility of choosing the type of policy that you want. Or if you have funds come in from somewhere else, you can earmark them to go towards paying off that mortgage debt. Whatever you want, whatever you choose, you can earmark the funds for at the time of planning. So you put that into place well before anything happens to you or to the child, because that's a possibility as well.
That's a good point. I didn't even think about that. So yes, you also may get some insurance on your child as
Mm,
well, you know.
yeah.
I don't have any other bullet points personally, so I'd like to open it up if you don't mind, Buki and Ria. I'd like to open it up for questions. So, uh, you are able to just take yourself off mute and ask questions, or you could put them in the chat. And then, Ria, I don't know if you still have Facebook open. If any Facebook questions have come up, we can answer those as well. I do see Susan's hand up. Hello, Susan.
Hi, Cherie. How are you?
I'm good. How are you today?
Good, good. We talked a little bit about a year ago.
I know
And
it's been a while.
yes, and I would like to talk to you again offline, but I did have a
Okay,
quick question. Do
sure.
you feel that in the situation with the parents and the kids and all that we're trying to do for our children to give them the life that we wanted to have ourselves,
Hmm.
do you feel that that we should have an LLC, or should we be going into this as our individual names? Is there a plus minus in terms of the having a lower cost down? That's only if you're doing it as individuals versus doing it under an LLC and the trust. I hear these things, trust, LLC, all these things. And I don't think I know enough to know what I'm supposed to do.
Okay. So I'm going to answer you from the lender point of view. You have to close in an individual's name or individuals' names in order to close a conventional loan with a lower down payment. An LLC or a trust, well, I'm saying LLC. If you want to close the loan in an LLC, it has to be an investor loan, which means minimum you're putting down 20%. Okay. What I have done, and again, talk to your own attorney about this, right? What I did with my own house is as soon as we closed, we went to our trust attorney, went to our estate attorney and said, put our title into a trust. 99.9% of the time, as long as you're making the mortgage payment, the bank is they don't care, right?
Mhm.
There's always that 1% though. So I have to just say that. But that's what the super majority of people are doing that are thinking like this. And the mortgage still stays in your individual names. So,
Mhm.
but the title moves over to a trust.
And that's for protection, it
Hmm.
protects your assets and, in the future when you do pass away, it helps to transfer your assets to your heirs without having to go through probate.
Hmm. Absolutely. Other questions that people have?
There's one in the chat, Cherie, and I think this one is for you. It says,
Okay, I'm not
"What
seeing it.
age At what age could a kid get a mortgage if income is not a requirement? Are there any other requirements?" And that question is from Caddy Cavalieri.
Hi, well, hello, Caddy. So 18 years old. You have to be 18 years old in order to be on the mortgage. And I'm sorry, what was the second question? It was about the income.
If income is not a requirement, are there any other requirements?
Are there any other requirements? No, it's so we will pull credit on your child. However, if they've just started college, uh, then that's fine. But they have to be 18 years old.
Mhm.
Hmm. Yeah.
Okay.
Other questions that people have? Maria.
Hi, how are you?
Hello. Good. How are you doing?
I'm doing well. So I'm a retired veteran.
Thank you
My
for your
daughter,
service.
you. My daughter goes to VCU and she graduates. She's graduating. Yes. Hi, Buky. And I have another daughter. She's graduating high school and she's going to VCU. So
Oh,
I have two
wow.
graduating.
Fantastic.
Yeah, I'm graduating college and graduating high school. So my college student, she's getting benefits from, of course, I'm 100% VA. So she's getting benefits. So I am thinking about selling my home in Stafford and getting a duplex.
Mhm.
And we're staying in one and using her benefits to pay for the mortgage for the other one. So we can save one and then we're using the other one for rental property. And then when
Okay.
the other one graduates in high school, so she's gonna get another benefit stipend from the VA, and we're just gonna, cycle it through. I don't have a job, so my question is, you actually answered the question, should I use an LLC? So I have two LLC. I have a catering business and I do have a real estate investment. I'm thinking about, well, I'm testing for my real estate license next week. But you kind of answered the question, should I use the LLC to buy a house or not? And you answered the question, no, basically, right? That's your answer, not to buy it.
Well, you can do it. You would have to do it through a DSCR loan, which basically means as long as the expected rental in well, you can do it if you're not going to live there and say it like that.
Mhm.
If you're not going to live there, you can buy it as an LLC and you can have, as long as the expected rental income will pay for the mortgage and your credit's got to be like a 660 or higher, um,
Mhm.
then you can do that. But if you're
Okay,
going to live in the property, then it's a no.
it's a no. Okay,
Hmm.
okay, but we're planning to live there, so
Yeah, so then it's a no.
it's a no. Okay,
Hmm.
all right, so,
Yeah.
okay.
So you have your own business. If you've owned your own business for more than 2 years, there's two things we can do. Either we can, and I think you said it was a catering business. So either we can look at your taxes for the past couple of years and you may qualify for a conventional loan, or we can take 12 months of your bank statements and you may qualify for a bank statement loan. So what they
Uh,
do with I'm sorry, go ahead.
the bank statement, personal bank statement, or both? With the,
It could be either. So I always tell my clients wherever you get like your uh, business income money from. So if you run a catering company, ABC Catering, and you've got ABC Catering bank statement, and whenever you bill clients, they pay you into that account, then that's the account that you want to show me.
okay, got it. Okay,
Yeah. And that's how a lot of people, a lot of my self-employed people are getting their loans. Now, I will tell you, with those loans, the minimum down payment is usually 10%. And then it goes up from there based on your credit. So if you have credit in the 600s, then you're usually at 20% down. And they do have minimums with regards to credit scores there. And they will also look at your debt to income for those bank statement loans as well. And we can talk about that more offline if you want, but that's a way for you to
hello.
get a,
You
bank
froze.
statement loan. Yeah. And those loans still have to close in your name. You cannot close those loans in an LLC.
Okay. Well, do you suggest taking it as a VA loan?
If you have the income, I would want to take a look at everything that you have and be
Okay.
able to come up with a mortgage plan for you. Because without me seeing everything, like I could say, well, yeah, you could do a VA loan, but if you don't have enough income from your business showing on your taxes, then I would have to come back to you and say, oops, sorry, you can't you can't do it, and I don't want to do that. So yeah, I would need to see everything.
Okay. Yes.
Hmm.
All right. Thank you. Appreciate it.
You're welcome. You're welcome. These are great questions, Buki.
Yes, yes, yes. And oh, Susan sent you a message.
Yes, I saw that. So that one came up for me. So I don't know where the other one was. Other questions? And Susan, yes, if you don't have my information, then um, everybody, I'm going to actually put my information in here. Call or text us at 571-583-4600. Um, I'm going to put it in the chat here. So that way you can get in touch with us. And I'm sure Buki's going to put her contact information in the chat as well. So you can contact her.
Yep, done.
Hmm. Other questions? Mm. Well, I think this is such an important topic, Buki, that we have kind of addressed today and gone through. While people are thinking of their final questions, what are your final couple of comments for people as they are, thinking about everything we said today?
So I just want to encourage people to think about this as an option because, you are really giving your children a financial head start and anything that you buy with them or for them today just really supports their needs today. And there's so much potential in the future that comes with it. You're not just buying a property, it's also about building wealth for your family and securing your family's financial future. So definitely think about it as an option.
And I would say that grid is a place where we build wealth through the power of real estate. And whenever I am talking with people and coaching people about their um, real estate portfolio,
Mhm,
um, this is like one of the ways for you to add another house to your portfolio,
mhm,
right? And the whole point of this series that we do with Zoom, I'm sorry, with Grid within Zoom, is to give you like different ideas and different ways and different property types that you can add to your real estate portfolio. And this is again one of those things. The other thing, Buki and I were talking about this before everyone came on. I graduated in 19, no, I'll admit it. I graduated in 97. And I wish my dad had picked me up by the pigtails when I graduated and I got my first job, and houses were like 100 grand in the DC area in certain places. Yes. And he picked me up by the pigtails and said, "You got your first job. We're going to get you your first home." Right? Because he
mhm,
had the money, so that wasn't it. And he owned his own home, and my mom owned her own home, and all of that. But how much farther I would be today if I had the benefit of, you know, the extra 10 years. Like it was 10 years later when I bought my home, right? Mm, 10 or 12, something like that,
mhm,
when I bought my home, right? But all of the equity that I lost
mhm,
because my dad didn't say, okay, you're a stable child, you're a good child, let's go and do this with you and for you now. My dad had the money, he could have paid the down payment, he would paid the closing costs, and he could have said, okay, now it's your mortgage. Here you go, right? And that would have been gifting, right?
mhm,
Just gifted me the money for that. So some of us are blessed and
mhm.
we are able to help our children with that. And then sometimes you're trying to build a portfolio, like I was saying. So
And
um,
sometimes people just don't know because my parents paid room and board uh,
mhm.
for me. And then I moved into an apartment after my first year and I paid my own rent. I had a job, I paid my rent, I paid my car note, and I had the same roommate for 3 years. And then I moved out and she moved somebody else in, but it was an apartment. Imagine if we knew then what we know now.
Yeah,
So,
you paid for somebody else as well. Susan
yes.
said, but Cherie, 100,000 then seemed like a lot. Like, how many of us are saying that today? Well, if we think back to we graduated college or we graduated high school, and what the prices were then, and we
Mhm.
thought they were a lot, and,
Yeah.
like,
Yeah.
and we look back, like those same houses are easily worth 500,000 today
Yes.
that were 100,000, 130,000 at the
Mhm.
time.
Mhm.
At the time. My mother bought a house in Fairfax, and it was like, and she bought it through the affordable dwelling units at the time, but they were like really nice houses, right? I think it was like 140,000
Uh-huh.
for her to get the property, a nice townhouse in Fairfax. I mean, those houses today are 500,000 to $600,000.
You can't get a condo for that.
Can't,
Yeah.
can't. Yeah, yeah. So, um, well, I don't see any other hands up. If anybody has a last minute question, let us know. Otherwise, we're gonna let you get back to the rest of your day. Okay, everybody. Thank you so much. Thank you,
Thank
Ria.
you.
Thank you, Grid, for hosting us. And we'll see you next month for another great conversation. And thank you, Buki, for being here.
Thank you for having me. Thanks, everyone.
Take care.
All right.
Bye-bye.